if these companies are saying they're typically seeing 20% of their residents leave them every year to buy a home, they're saying it's cut in less than half. So it's less than 10% now, which I totally believe it and it makes sense. And what that means is there's just more demand for multifamily, which is great, which then helps. That's one element that helps push up rental prices. The other element that's more powerful in this case, that's going to push up rents, is the cessation of new supply coming to the market, right? Because with less new units, there's going to be less competition, and that's going to also push rents up. So, of course, everything has to be in equilibrium. So if right now the gap between renting and homeownership is $1,000 a month, and rents go up a lot, that gap might squeeze down, and maybe interest rates come down as well. So now that gap's further, you have to have some gap, right? Because if it's cheaper to own a home, then your multifamily thesis is not going to work too well. So,
and at one point it was close when the mortgage rates were really low, and call it 2020, end of 2020. That was really compelling. That the story was there, but then obviously what happened? Everyone started to build.
Yeah, it's tough to get it right, but it's interesting to track, and I think that multifamily, like the Wall Street Journal article is saying, is poised to do very well over the next few years or so. However, you and I, we don't invest in an index, right? We invest in particular properties that are in particular markets. So
dollar cost averaged.
You have to dig into the fundamentals of the particular market. And okay, yeah, nationally maybe rents are recovering, but they're not in Austin, they're not in Phoenix, right? So you need to look at the individual market and figure out, okay, what does the supply pipeline look like versus the demand, not just for the market as a whole, but in your submarket, and take that into account when you're doing your underwriting.